We'll be looking at the continuation of lease in today's lesson, and we'll do a quick recap on previous lessons we've done. And currently we're in the part 4 of lease treatment. In part 1 we talked about IS 17 lease, and we gave frequently used terms used in lease. That was basically the written aspect of lease on IS 17. In the part 2 we gave examples of treatments in IS 17, that's the lease. The part 3, which we did some days ago, we gave the difference between Ifrs 16 lease treatments and IS 17 lease treatments. Now IS 17 is no longer in use. We have a new standard on lease, which is Ifrs 16, and it bears the same name as the previous standard, as lease. So currently we'll be looking at the difference in the calculation of both lease standards, the old one IS 17 and the new one Ifrs 16 lease. Now into today's topic, the part 4, we have Ifrs 16 lease, new financial reporting standards and potential implications. So in the topic we're going to be looking at the contents as the introduction, the current position of Ifrs 16 leases, and worked examples. So we'll move over quickly into the notes aspect of it, and it says the new financial reporting standard for leases will significantly impact on many corporates' reported earnings, assets and liabilities, and will change the classification of expense and cash flows, such that reported results and the associated impact on covenant tests may well vary materially. Now, the notes and some calculations gotten here have reference to Deloitte UK, which were made at the bottom of this note. So majority of the notes here was derived from Deloitte UK, since this is a new standard, and they gave guidance also to what we could do and treatments we could also do. So also ACCA Global. So their websites are there for you to check out. And it says will Ifrs 16 is only applicable to periods from 1st January 2019. Now on 1st January 2019, we'd have about 2 or 1 annual financial statements by company prepared using this standard, so it's relatively new. And it says lenders and their corporate borrowers should start evaluating the potential impact of this norm, as at the time this note was written, 1st January 2019 was not yet the date. So we'll go over, and it says to avoid surprises when the standard is implemented. Now it's implemented, it may have a bearing on current negotiations regarding future covenants, cash sweep mechanisms, management incentive structures, and the like. We anticipate that the new standard will have the greatest impact on businesses with large portfolios of short leasehold properties, such as retailers, pubs/restaurant chains, or other sizable assets under operating leases. Now, as we discussed previously, the new standard basically has a major change in the treatment of operating lease in the leases books. Now, previously, operating leases in the leases books was expensed in the profit or loss account. And currently, the new standard tells us that we shouldn't expense the payment again, rather we should capitalize the cost of the assets and depreciate it yearly. Now we'll go into the treatment of that shortly. Then we move to the introduction. Following the release of an exposure draft in 2010, the ISB, International Accounting Standard Board, has finally released the IFRS 16, a new standard on lease accounting. This is to replace IAS 17, the previous lease standard. Because this standard, which is mandatory for periods commencing on or after 1st January 2019, will require leases to account for all leases in, or rather on, their balance sheet. I'll take it slowly. Will require lessees to account for all leases on their balance sheet, including those which had previously been treated as operating leases and accounted for in the profit or loss account as an in-year expense. This would include leases of retail and commercial property, equipment, and vehicle. Accordingly, affected corporates will see. So what would expect, or what we should expect is the assets and liabilities on the balance sheet increase significantly, with a potential material impact on covenant calculations. So previously, when we were not supposed to capitalize the leased assets, the operating leased assets, we were required to expense it, but now the asset should be capitalized, and once an asset is capitalized, the balance the balance sheet, now called statement of financial position, assets value would increase with the value of the operating leased asset. So we have worked examples here, and it says, as a simple example, a company taking out a 20-year lease at an annual rental of 1 million naira with no breakup clauses and an illustrative incremental borrowing rate of 6%, will recognize a right to use assets, ignoring related costs, and a matching financial liability of 11.5 million naira, being the discounted value at 6% per annum of future lease payments. Now, I'd highlighted the important things we need here. First is the lease term, which is 20 years, then the annual rental payment of 1 million naira each year, then the incremental borrowing rate, we have 6%, then the matching financial liability, which is equivalent to the cost of the asset itself, as 11.5 million. Now, if we look at this clearly, we'll see that if 1 million naira is paid yearly for 20 years, we have 1 million times 20, that's 20 million naira, and the cost of the asset itself is 11.5 million. So there's a difference there, there's a gain, and that gain goes to the lessor, that's the person who leases the assets. The gain here we have is 20 million less 11.5 million, and we have about 8.5 million naira. Now this gain is called a finance cost to the lessee, that's the person leasing the asset. Now, in each annual payment, in real term, in each 1 million naira payment, as we have here, there is a part of the 1 million that is paid for the asset itself, and another part that covers the gain of the lessor each year. So that gain, the gain part, so in the 1 million we have the gain part, which is the finance cost, and we have the actual cost of the asset part, which is paid for, the capital part, which is paid for the assets. And we have examples on that. And says, in the first year of the lease, the company will recognize in its income statement expense of, we have 575,000 naira for depreciation. How did we get that? We use straight line basis, and the basis must be written down in the question. If it's not written down in the question, then it is appropriate to use straight line basis. So we have, how did you get that? We have cost of the assets 11.5 million, divide by 20 years, that's the lease term. We have 20 years here, so we effectively got 575,000 naira as the depreciation yearly. So each year, from the value of the assets in the statement of financial position, we will deduct 575,000 naira, and this 575,000 is transferred as an expense in the income statement. So secondly, what we do is to look for the interest cost. Now this is the gain part on the 1 million naira you pay. As said earlier, that the 1 million naira has the actual payment for the assets and also the gain part, which is the interest rate. Now the gain part is the gain part to the lessor, not the lessee. To the lessee, it's a cost to him. So how would we get the interest cost? We have the incremental borrowing rate of 6%. We'll use the 6% on the matching financial liability of 11.5. So how we'll get this is 11.5 million naira times 0.06. That's 11,115,000,000 times 0.06. So we would have 690,000 naira as the interest cost for every 1 million naira payment paid yearly. So if we have 1 million naira paid, if I pay 1 million naira and the interest part is 690,000, so there's a balance there, there's a difference there. The difference there is the actual payment for the assets itself, not the gain now. So the difference we have in 1 million less 690,000 is 310,000 naira. Now we'll look at what that 310,000 naira means further down. Now it says it can be said that this will result in a year one income statement expense of 1.265 million, that's 1,265,000 naira. How did you get this? We got the depreciation 575,000 naira here. Then we added the interest cost. The interest cost is expensed in the income statement. So the total expense you have using Ifrs 16, that's the new lease treatment, you have the depreciation plus the interest cost, but you show this separately in your income statement. We have 575,000 plus 690,000, and it gives us 1.265 million naira. That's 1,265,000 naira. So if we compare this to the old standard treatment, that's IS 17, we'd see that when IS 17 required that we only expense the amounts paid yearly, that's the 1 million naira paid yearly, we'll put it as an expense. Under the new standard, the total expense we have is 1.265 million. The old standard would give us a total expense of 1 million naira, which is shorter than or which is shorter than the new standard treatment rather. So the difference we have there is 265,000 naira. The gap we have there for the first year is 265,000. So if you use the old standard, you have 1 million as expense, or the new standard will give you 1.265 million as expense. So there's a difference there. Now from this we could get something which we'll put later on. We'll pause that, and it says at the end of year one there will be a mismatch between the value of lease assets and the associated liability, with the liability being higher, thus impacting on the overall net assets rather. The assets will be reduced from 11.5 million naira to 10.925 million naira. How did we get this? We did 11.5 million naira less the depreciation of 575,000 naira. So remember, you capitalize the 11.5 million naira, then you less the depreciation, the yearly depreciation for year one. We have 575,000. That would effectively give us 10.925 million naira as your net book value or residue. So how do we treat the liability? It says the liability will also decrease from 11.5 million, that's the cost of the asset. So previously it was 11.5 million as liability, to 11.19 million. How did we get this? We did 11.5 million less 0.31 million, that's 310,000. Remember, we talked about the actual cost first, paid here 1 million less 690,000. That's now the actual value of the asset that is paid for in year one is 310,000. So here we have it. It is less from the value of your initial liability of 11.5 million. That's get in here, it calls it the loan repayment. Then the interest part, now 0.69 million, is expensed, as we said here, right here, 575,000 plus the 690,000 as expense. So in total, in this example, we have 575,000 naira as depreciation, 690,000 as interest cost, then 310,000 as the actual payment for the assets for year one that would be posted in our year one's financial statements. So it says over the life of the lease, income statement expense will generally be higher than under the current, that should be previous standards, towards the start of the lease periods and lower towards the end. So we talked about that here. The current standard has a cost of 1.265 million at year one, while the previous standard IS 17 has 1 million as cost in year one. So effectively, the current standard IFRS 16 has a higher expense value at the initial years of the lease than the old standard. Then over the years, the expense value starts to decrease until it gets lower than the old standard, which we said here rather. Then we have the new standard makes expense higher at earlier periods in the leases books for earlier years. Two, depreciation figures for operating leases are introduced. Previously, there were no depreciation for operating lease in the leases books. Depreciation, less depreciation from asset value in the statement of financial position, which we did here, right here, 11.5 million to 10.925 million. The difference was the depreciation of 575,000 gotten here through our calculations by dividing by 20 years. Then less depreciation as an expense, we did it here. The expense is here. We have depreciation as an expense here. That gave us a total figure with interest costs. That gave us a total figure of 1.265 million when added with interest costs. So we have it here. Less depreciation as an expense in the income statement. And lease liability is recognized and apportioned yearly. So we'll go to the second example, and this example came out in our part 2. We treated it, but it was under finance lease. But now that the treatment of finance lease is similar to operating lease, we could make some adjustments and treat it to know how the treatment works in the new operating lease. So it says Ibadan Construction enters into a 6-year lease of a machine on 1st January year 1. The fair value of the machine at the commencement of the lease was 80,000 naira, and Ibadan Construction incurred initial direct costs of 2,000 naira when arranging the lease. The annual lease payments are 18,000 naira yearly, payable at the end of each year. The estimated residual value of the asset at the end of the lease is 8,000, and Ibadan Construction has guaranteed this amount. The interest rate implicit in the lease is 11.17675%. How would we get that? Now that should be operating lease liability. It says year 1, the opening liability, that is the cost of the asset, like as we did previously, 80,000 naira. You pick the cost of the asset, then you get the interest, the interest rate implicit on the opening liability, that is the cost of the asset, like we did previously. We have 11.17675% of 80,000 naira. It gave us 8,941 naira. So how we would calculate this would be 80,000 naira times 0.01117671. So we could round up that. Then the lease payment remains constant yearly. Previous example gave us 1 million naira yearly. This example has 18,000 naira yearly. We would write it down. So after getting that, how did we get the capital payments? Now, as we said before, that there's a capital payment in each lease payment, and there is also the interest part, which is the gain to the lessor. So we have the lease payment 18,000 less the interest rate implicit on the opening liability, which we have here as 8,941. So 18,000 less 8,941 gives us a figure of 9,059 naira. So now we know the capital part, we know the interest part. The closing liability was gotten by 80,000 naira, the opening liability, plus the interest part, 8,941, less the lease payments. How much have we paid out of all our debt? And we paid 18,000 naira in year 1. So it gave us a balance of 70,941. Now the interest part is to be paid, is adding to your debt, which will be paid at the end of each year. So we move it on and on. The year 1 closing liability becomes the opening liability for year 2. Year 2's closing liability becomes the opening liability for year 3, and on and on. It says the interest expense is calculated by multiplying the opening liability, which we have here 80,000, by 11.17671, the interest rate implicit, which we got here, and we got it as 8,941 in year 1, 7,929 in year 2, 6,803 in year 3, 5,552 in year 4, 4,161 in year 5, 2,614 in year 6. So we move to the operating lease accounting. Then we have the initial accounting. How do we treat operating leases initially when it is first incurred or when it first occurs? So we have the initial accounting is that the lease should be capitalized and set up lease liability for the value of assets to be recognized, like we did for the first example. So how do we do this? We debit non-current assets, then we credit lease liability. That should be lease liability. Then subsequent accounting is all we should do. First, debit the non-current asset value, that means add to the non-current asset value, then you'd credit the lease liability, that is add to the lease liability, since liabilities are supposed to be credited to add to them. And subsequently, that's further years, you'd depreciate. It says following the initial capitalization of the leased asset, depreciation should be charged on the assets over the shorter of the lease term or the useful economic life of the asset. This for accounting for this would be you debit depreciation and you credit accumulated depreciation. Depreciation goes to your expense in the profit or loss account as we treated in the example 1 of this lesson. It says lease, rental, or interest. It says, now we have a short example here. When you look at a lease agreement, it should be relatively easy to see that there is a finance cost tied up within the transaction. For example, a company could buy an asset with a useful economic life of 4 years for, now we have dollars here, $10,000, or lease it for 4 years paying a rental of $3,000 per annum. Now, like we did in example 1, here we have 4 years and we're going to pay $3,000 per annum. So 4 times $3,000, that's the total payments that should be made for the assets over the life, is 4 times $3,000, which is $12,000. Now the cost of the asset itself was $10,000. So the difference, $10,000 less $12,000 rather less $10,000, which is $2,000, is the gain to the lessor, is the interest cost. Now this is a gain to the lessor, but a cost to the lessee. Now the lessee is who is getting the assets and paying value to the lessor. Now we have i.e. the finance charge as said here. The difference between the total lease cost, that's 12,000, and the purchase price of the assets, that's 10,000. The difference is the finance charge, which is 2,000. When a company pays a rental, in effect, it is making a capital repayment, which we got previously in our example 1 and example 2. We have the capital repayment and an interest payment, which is the gain to the lease. Also, in each payment, we have the capital payment, we have the interest payment. The impact of this will need to be shown within the financial statements in form of finance costs. In the statement of profit or loss, there we expense the finance cost. Remember, we expensed it with the depreciation and a reduction in the outstanding liability in the statement of financial position. And the capital part we got, that was 310,000 naira before, was less from the finance liabilities value in the statement of financial position, while the difference between 1 million and 310,000, which was 690,000, which was the interest payment, should be expensed in the income statement. Now at the end of this, we have the reference to Deloitte UK, then I Can Study Park, then ACCA Global. So that's the end of the topic today. I hope you enjoyed it.